Hello everyone. Today we're going to do some tape reading, and I just want to go over a market maker style model yesterday. I want to go over some silver analysis combined with gold. Okay, so after this, I'm going to be tape reading live. What's going on right now? Yeah, so we just had CPI, took data lows after inversing this, didn't take any liquidity, so didn't like this inversion, but it worked out. Okay, so let's go into grading MMXM price swings. Okay, so a MMXM can happen in two ways. The inception or manipulation can either be at a key level or to a key level. What I mean by this is, for example, here, this manipulation happened towards a key level. So basically, what it would look like is here, like you would have your key level, and then either it will look like this, okay, it would move down lower, and then incept at the key level, and then start the market maker buy model. Or what it could do, if the array is like here, is that it could do this. Go lower, and then incept at some key level, and then start trading higher to finish the terminus at the key level. So you can deliver from a key level and to a key level, basically. Okay, so in this example, we are delivering to a key level, which is the consequent encroachment of a high time frame imbalance plus a mitigation block. So if you notice here, we had this accumulation pre and during Powell. So pre-Powell was a bunch of accumulation back and forward. Powell speaking, which is about 10 a.m., we got this manipulation higher, which was the stage 1 inception. This would give you your model 1. So on the second stage is where we start distribution and where we're most likely to deliver to discount, and we have the high risk sell. So as you can see, we have the market shift from this low right here. We mark it out so it looks visually pleasing. We go ahead and just make a embed. Okay, so there's the market shift and the 2022 model fair value gap retrace, which would be at this gap right here. Well, that's your 2022 model sell. Third stage, which is the turtle soup and the delivery through discount and into quadrant 3, which happened here. So as you can see, it's all part of distribution range. We turtle soup this high, tap into this order block here, and then we deliver to stage 4, which is just a displacing move to terminus, which is the finish at the high time frame mitigation. So yeah, that's basically the sell model that occurred on Wednesday, 10 July 2024. So just this. Okay, let's go back to the price action. Okay, so, oh yeah, before we get into tape reading, I want to go over my drawn liquidity on silver and what happened recently. So we have this mitigation range here. Drop into the 4-hour. I have some more annotations on it. So that high time frame mitigation can be scaled down into an 8-hour inefficiency here. So what happened is that we have this mitigation right here. So and then we retrace with this. what I wanted to see on this low is that we take it and then start moving lower and then make the failure swing. We didn't get that, but we did have a SMT with gold. So as you can see, it's this low, and this low, this low, and this higher low. After this, we got this turtle soup, and as everyone might know, which I've spoken about lately, bearish breakers and bullish order flows or bullish turtle soups. And I did, this is not from me, this is learned from someone else. Adenomics, if you want to go check him out, let me just write it down there. If you guys want to go check him out. So yeah, so basically a bearish breaker, so a high, a low, a higher high, lower low. If order flow was truly bearish, what would have happened is we go and take this low, retrace into the breaker like this, and then we move lower. But since that did not happen, and this bearish breaker formation was in bullish order flow, it was just a turtle soup. And there's that failure swing that we get after SMPing the initial mitigation low, which is really nice to see. There are three scenarios which are taught by economics. So the first one is that if we take this low, or the second one is if we SMT it, and the third one is if we have a failure swing. So us having a failure swing is perfect. It's actually in our interests. After this failure swing and this turtle soup, and by the way, this turtle soup did not happen on gold. So as you can see, wait, what low was this? The 10 p.m. low. Where's 10 p.m.? Yeah, so here, so as you can see, it's not a swing low, but on silver it is. So we sweep that, we go trade higher, and then here, within this candle, in 19 minutes, we would have our change in state of delivery, and we probably have one on the lower time frame, such as on the lower time frame. Yes, but yeah, so this closing above this move lower is the change in state of delivery. And I anticipate it's going to happen in 19 minutes. So we basically inverse this, get this future change in state of delivery, and then we deliver to range high. Now taking the move lower before the move higher, you can see I have my standard deviation marked here. And the minus 2.5 to minus 2 zone lines up with these equal highs here. So my current drawn liquidity for silver is these two equal highs. This high, if it gets hit, it gets hit. If it doesn't get hit, then I don't really mind because this high was SMT'd. So yeah, that's generally what I'm looking for on gold. So if you can see, we have the mitigation block right here, which we narrowed down on the 8-hour to inefficiency, move lower into that, and then we take the range high. So this was our price condition for the range high or range low being taken. And by the way, the range low being set inside of a inefficiency just gives me more confidence that this range, the range high might be met more likely than the range low, because this here now, this low here becomes a high resistance low, because what happened is when we formed this low, we changed the state in delivery, we closed above a previous high, giving us a market shift, and now we're feeling to the space above this high, but I want to see it close above this high and eventually meet this high. So first drawn liquidity met, which was this high, and I pointed it out recently. So yeah. So yeah, that's pretty much it. So I'm hoping we can meet the minus 2.5 mark. Let me just drag it out for a second. Yeah, so minus 2.5 is right there. So possibly here, and that does not line up with any liquidity, but but it's valid because we're above these two equal highs here. Okay, so that's it for silver. CPI today brought us to the range high, so if I were to take this inversion on Wednesday, I would have hit take profit. But I didn't. I'm just gonna be honest here, I did not take it. But I might be looking for another range to be formed off of the 4-hour or maybe even the daily if we do not reach this high within, like, what I'm basically saying is that if we don't reach this high within a couple of days, once we close above this high, I will have a new mitigation range inside of a mitigation range. So this will be um, my axis 1, and I'll have another axis 2, which would be from, let's say the range was created and stopped here. Okay, so let's say the range went up here and then the swing high was here. I'm going to have this mitigation block here to find another setup that looks identical to this one, but just like duplicated. And then that would take us to standard deviation 2.5. Okay, so that's it for silver. Let's get into tape reading. Okay, so let's look at the daily chart. Okay, so yesterday was a huge expansion day. We had lots of up movement, lots of momentum, until we died off during the end of PM session, where we accumulated lots of liquidity for CPI. And what might happen today is, if we want to see lower prices, sorry, if we want to see lower prices, I want to see this candle's range being rebalanced. So possibly a move back into here, and then we can decide on lower time frames, reassessment, to see if we want to go higher or lower. And for yesterday, my draw actually perfectly worked out. So let me pull up my Notion notebook. Okay, so here you can see for Wednesday, which was yesterday. Actually, let me change this symbol because I just finished it. Okay, so for Wednesday, I had this high marked out, and what I said is drawn liquidity is range high. After we take that range, I expect a small one higher above it, followed by retracing to the mitigation zone, which will be the assessment point. The assessment point is basically just where I will look into lower time frames and look for stuff that would hint a reversal or change in delivery. So here, this was at 9:03 when the drawn liquidity was not yet hit. So I expected a move higher and then a move back lower into previous range equilibrium, which I do not have. I have it marked out incorrectly here. This 0 should be at this high, and the equilibrium would be somewhere around here, somewhere around this level. Let me actually pull up a snippet tool and I can annotate it so you guys can better understand. So yeah, so this 0 should be here. Oops. Should be there, and the 1 is there, and this discount will be moved approximately this much, so that's around like here. So discount would be around there. So yeah, I expected a small move higher above this range high, taking it, and then I wanted to spend some time here until we moved lower into a discount, mitigated this mitigation block, and then reassess as I have marked out with this map defined scope. Reassess on lower time frames, look for change in delivery, and then we can either anticipate higher prices or we can anticipate this to be inversed, especially this imbalance here. This one here. This was really significant to me because that was my key price condition array. So however we reacted within this array here, however we reacted in this array here would determine if we are going to go to range low, or going back to create a new range high. So I'll get into the reassessment just in a second. But yeah, so the result, what happened was we ran the range high, we spent some time there, retraced lower, but we fell short of the previous range. Yeah, here I have it corrected. I have the high and the low. We fell short of the previous range equilibrium, but we mitigated this mitigation block here, and with every mitigation block that you have created, you have something called a mitigation or mitigation range, or whatever you want to call it. So yeah, so the range from this low to this high would serve as a mitigation range, even though we did not reach the previous range mitigation, that we did not reach the previous range array at equilibrium, we still got a lower time frame mitigation range discount to equilibrium and mitigation, and we had this imbalance here get filled. So after we ran the high, we had a steep retrace mitigation that was created as we moved to take the range high. After we took the range high, we should expect to retrace the orange box, which I took as a price condition for lifetime firm assessment. However, we only got the retrace into the discount over the mitigation range with the use of the 930 Judas swing, which was the opposite of the drawn liquidity. So as you can see here, I have the mitigation range marked out, which was from this low to this high. And then we got a retrace into discount of the price level and this imbalance here, which I think was on the 4-hour. Yeah, it was on the 4-hour. And the mitigation, and we have the reassessment take place here instead of here, which where I had originally marked out. So let's move into the assessment. So here is the move into it. The reassessment point is around this yellow box here, and into the mitigation as well. On the 15-minute, nothing really happened, but this is the 15-minute. On the 15-minute, nothing was really there. Hourly, it was just the same framework as the 15-minute, and then when we move into the 5-minute, you can see that we have this move lower, giving us that market maker sell model that I just highlighted. And then after we got this mitigation range tapped into, we had this inversion, changing state of delivery, and then we had a breaker being respected, because you see how I just mentioned recently before this that if we were in bearish order flow, this breaker formation would have acted as a turtle soup. But you can see that we create the breaker and we move back into it, and we have a fair value gap in here, which gives us a unicorn, and then we move higher, take out the range high, which means that my assessment for the initial one was went as planned. So, for example, here, if we just let me get my sticky tool out. So here, if we had just moved back into this array and continue the liquidity imbalance cycle, which is like this imbalance, liquidity, imbalance, liquidity, imbalance, liquidity, to reach a key level, and then we start reversing imbalance, liquidity, until we reach a key level, and then we see we start reversing. You get the point. So if the liquidity imbalance cycle was to continue, it would have respected this array and continued lower to make a new low. But it didn't. We inversed it. Moved higher, creating a breaker. We retraced into the breaker. If order flow was bearish, we would have disrespected this and then moved lower. But what happened is we moved into it, respected it, and moved higher. After we took this range high, this was all-time highs. And if you guys can notice, there's another market maker buy model, which I will not go into grading price swings right now. But you can use what I taught in the beginning to grade it. You can just take here like the levels approximately. So the incept. Oops, I'm driving. So the inception, the delivery to discount, and then the quick displacement to terminus. So remember how I spoke about the two types of market maker models, the one that has the retracement, the inception to the key level, and the one that terminuses at the key level. I don't even know that's the word, terminuses. So this one was a move into a key level. The one prior to this, which was this one, was a move from an inception into a key level. I hope that makes sense. That's the best way I can word it. So you can see here from a inception to a terminus at a key level, and then from a key level inception to a terminus at the range high. Okay, so I hope that clears stuff about the liquidity imbalance cycle, and I hope that makes the market maker models clear. Oh yeah, here are just some ideas that I could take. Okay, so let's go back into TradingView. Okay, so where were we? Okay, yeah. So on the 4-hour, there's pretty much nothing to go off of except this accumulation here, and I'm gonna ignore this big wick here, like this, and where's wicks? So if you can see, with no wicks, it just looks like we're just trending in this range right here. So no really volatile movement. Now I think 8:30 will kickstart it up, but let's go down to 1-hour, finding more prominent ranges. So what I see here is accumulation, possible manipulation lower. Previous range. So my first area that I would want to see a move back into is, first of all, equilibrium of this range. Within equilibrium, you can see we have this mitigation block right here, and paired with the imbalance right there. So I should just change this color. Okay, so what this looks like is a bunch of accumulation, a big spike up here, which I think is a fake out. So and when I say fake out in terms of manipulation, I don't believe this was manipulation. I think this was just, actually, there's no word for this I can say. So it's just basically manipulation. Accumulation. It's accumulation. Then we have this big move higher because of the 8:30 news. But because we didn't close anywhere significant in this area, this here was just a possible reassessment point, just for us to view on lower time frames to reassess if was this manipulation or was this just a breakout of the range. But what I think the true manipulation is going to be is this move lower here. This move lower here into equilibrium and into this possible mitigation right here will serve as my new assessment point. So, and then at this point here, I'll get the magnifying glass out so you can see. I'll scale on lower time frames, and I'll reassess on lower time frames whether we're going to treat this key level here as a manipulation or are we going to distribute further lower. And this is going to be the true manipulation, because let's go on the 50-minute time frame. Okay, so on the 50-minute, what it looks like is we had accumulation, manipulation at 8:30 news, and then we see a drive lower at 9:30. And many people will think that this can be our distribution. What I think is that this is just a fake manipulation, and this is the true manipulation here, and then we can expect distribution higher to take out data high. Because let's take away the wicks here. You can see accumulation, manipulation into this equilibrium, and then distribution to the range high or data high, which is around this level here. So that's basically what I have till now. So this previous range equilibrium, accumulation, fake manipulation, real manipulation lower, reassessment point on lower time frames for changing state of delivery, inversions, whatever, and then whatever we see on the lower time frame, we can implement it going higher. So let's go down to the lower time frame. Once we take this low here, that will be our new mitigation range. There you go. So that low right there taken, this can be formed as our new mitigation range. And let's draw out this mitigation block here. But as you can see, you see how we're falling very short of it. That honestly tells me that if we were to retrace higher, we are more than definitely going to return to it later. So let me just redraw equilibrium. So if you're looking to trade into a manipulation, if you trade manipulations, I would probably go look for a retrace into equilibrium here, and then into this mitigation block, lower time frame reassessment, and then take it to this equilibrium point, which is, yeah, it's equilibrium. But we might take and mitigate the range now. So yeah, just see what happens. Okay, so we mitigate equilibrium of the high time frame range. And still, I do not think that this was the manipulation. I believe this is the manipulation. If we get a reassessment that we want to go higher here. I think I'm all over the place right now. I want to say in one clear sentence so I can get the message out. This is for me and for people watching. Us accumulating here is confirmed accumulation. This big wick higher, if you took it out of the equation, this is just accumulation. This move higher here on the wick was fake manipulation because there is no key level to go off of. So there's two types of AMD. The first type of AMD is the one where we manipulate into a blank space. So we manipulate here, and then we distribute into a key level, and we reassess there. So this is the first type of AMD. Draw the assessment points. Okay. Wait, hold on, just give me a second. I want to draw out the. No, I want to put an alert. Okay, so we're in the mitigation block right now. Okay, no alerts. Okay, so here, that would be the reassessment point. This is AMD1, where it goes into a key level. The second type of AMD is an AMD where it looks like this. Manipulates into a key level, distributes to range high. Like this. So one where the manipulation is higher and then it distributes to the key level and there's a reassessment point. And then there's one where the manipulation is into a key level and then we distribute to the range high. So what I believe is happening here is neither of these. I think with this news here, this was still all accumulation. If we be closed up here, then I would say, okay, that's manipulation case 1, where we manipulate higher and then we distribute lower. But since it's just a big wick higher, and the bodies stay in like the same range, if I put it on the line chart, it will make much more sense. So look, accumulation, manipulation, and then distribution. So yeah, I think I got my point out there way cleaner. I think you know more understand it now. So this all registers as accumulation. This does not register as manipulation to me. This is the real manipulation, because you can see how we just basically move how many ticks or how many points is that? 114 points in less than an hour. Oops. Okay, so reassessment, as I said before, is going to be at this level here. So I want to take a screenshot of this for my Notion. Here, let's go. Where's that called? Okay, so first assessment point, not counting the big wick higher as manipulation, since it did not body close there, leaving the bodies in the same range until we got our true manipulation at until we got our true manipulation. Yeah. And let me take off the wicks. So accumulation, take off the lines, manipulation. Oops, what manipulation. And then anticipating distribution, like this. Okay, so let's move into the 15-minute time frame. So we have this big inefficiency here, which if we don't rebalance, I'll be looking for that to get inversed. So reassessment on lower time frame right now is we're pushing down into deep discount, fourth quadrant, and if we start looking at signs of moving lower, like no signs in changes in state of delivery or anything, it might reach down to range low. So inbox is follow as a can't spell inefficiency. Inefficiency. As well as the efficiency. reassessment. Is there if we can get time signs of reversal, treating that as a and not a breakout of the range. Okay, so we're displacing really heavily. We just took range low. Lower time frame assessments did not prove that we're gonna stop and reverse here and go to range high. Okay. You can see this happen because Asia and London just accumulated a bunch. So I can imagine there's lots of liquidity lying at this low here, and at this tight resistance around here. So there's equal lows here, which if we're going to continue lower, we might reach into. And yeah, that's the only level of equal lows, higher time frame, that we have any interest in. Price has not been retracing into any of these imbalances and left this mitigation block alone. So it's in a rush to meet whatever predetermined drawn liquidity it has right now, which I'm assuming are these equal lows. So honestly, you might get away with taking like a Zekin's inversion into this equal lows. I think the final retracement that will happen before we get these equal lows. Looking at higher time frame, this candle here, consolidating. If we respect this mitigation block here, okay, so mitigation zone, trace back into it, discount, mitigation block, and I think that might be the final retracement to the first two equal lows. This inversion here actually would not have been bad at all to take. Look at the strange low. That would have been nice. Might not see the equal lows because it was on a daily. So we might see some reversals off of this. Volume imbalance give us a market maker buy model. See the 5-minute. Yeah, so I'm gonna be hopping in a call now with a friend of mine. I'll link his channel in the description of this video. Yo, hello.
Hello?
Yo, what's good?
Not much, man. Honestly, I took a loss this morning.
On what?
Nasdaq.
Try to short it or buy?
I wanted to short it, but I didn't have what it my model required to short it. And then I saw a long, and I decided to take it after like almost 10 minutes
Share your screen. I want to see it.
of considering it. It was a bad trade. Yeah, sure.
We could do a recap on it if you want.
Yeah, I recorded it. I'm gonna post the recording. You'll see on the recording I'm completely backwards. I was saying it was going to go lower initially.
I'm gonna short my
Um,
video. Is that fine with you?
yeah.
Okay, yeah. So yeah. Okay, you
Yeah,
can explain.
I was looking for this high or these highs before going lower above the midnight open because I noted 9:30 opened up and went lower. So it was about me it was right here where I got stopped. And actually it was this candle. And I waited a while because on the 5 minute I had my order block form after trading beneath that low. We had trade to current day low here. And so initially, I wanted it to run down to the measuring gap, and if it was going to go through it, then I wanted it to run to the sell side liquidity. And that's what I said initially. I was going to look for shorts, but there wasn't any, like, I didn't want to chase it. I wanted to see some manipulation to go short. But usually I wait until that manipulation happens, see if it happens, and if it happens, then I go short. But instead, I decided to long it after, like, I longed it around 10, I think it was 10:05 or 10:06. I waited a very long time. I could have inversed it earlier, and I didn't because it was poor quality. But after a while of finding support in this inverse fair value gap, I decided to long it at 10:05, and I had like a mental time stop. Well, I had a 15-point stop loss, but I also had a mental time stop because I wanted to see that 5 minute candle really run higher. This one at 10:05 really run higher really quickly. So if it didn't close higher, I would have closed the trade. And so that's why I just decided to take it and ended up taking a loss. But looking back, like there's no real way I could have gotten short with my model today at all. Like there's no really manipulation ever taken except for at the 9:30 open when it retraces and trades above forms that triple top and then creates that bearish fair value gap. It's institutional overflow entry drill, but that's 9:30 open. I don't trade that.
Do you want to see why this contradicts my model?
Hmm?
Do you want to see why this contradicts my model?
Yeah, go ahead.
So your long was around here, right? On this 5 minute candle.
Yeah.
Okay, so the first thing I want to note about this price leg right here, I actually spoke about this earlier. So if you measure this range, which is the mitigation range, you can see we
Mhm.
actually have a mitigation block within here.
Yeah.
Give me a
Yeah, the
second.
overflow is still bearish.
Give me a second. I'm gonna call. Okay.
Mm.
Okay. Yeah. Hello. I'm back. Okay.
Yeah.
Yeah. So I was saying, um, my model contradicts your buy because you can see we have the most previous mitigation range, and the mitigation block is within the equilibrium point. And also, what happens here? Yeah, that's it for the 5 minute. Okay, so if you go to now down to the 1 minute, you can see we have this mitigation range. I can narrow it down into, first of all, this gap here, which was in the premium of the range. So you can see how you would take okay, so the higher time frame inversion would be on the 2 minute. So I was actually looking at the short here. So so the candle closes there. I don't take this candle close. Did it even close below? Yeah, it closed below by one tick. I don't take these candle
Mm-hmm.
closes because that's not how inversions work. Like institutionally, it's supposed to be like a deep close. And you can see if you targeted the range low using this mitigation and then narrow it down to an efficiency, this was actually a really good short setup. You can have your stop a close back below the inversion on the 2 minutes. So like this. And
Mm-hmm.
some people actually that trade the same model took this. So yeah, that's it. That's why I wouldn't long that. And I'm pretty sure there was a S&T lower time frame within these two highs. Let me just take a look.
Yeah. Yeah, usually I would not long that, but I just took it because I was just, I don't know, it was a mistake. Focus error.
Yeah, there's S&T within those two highs.
Mm-hmm.
So this high here and that high. So
If I had I wanted to short it, I would have shorted this inverse fair value gap if I was more confident, but I wanted to see it run up and manipulate,
what's your model though? Like
and so I
what's it
wasn't
like?
willing to short anything. Oh, it's just a breaker, so we come down to premium sell side liquidity or premium array. We make an initial run higher, and then we come back down and go long. And then that break of the lows of turtle soup, market structure shift, 2022 model. But I usually take part on an inverse fair value gap before the retracement into the 2022 model range.
Is this your entry vessel or is that your like foundation?
This is the foundation. The entry can be anything, order block, fair value gap. But yeah, see, like that's what happened. The pattern was there to long, and I didn't want to take it initially, but after like 10 minutes I said, you know what, I'm just gonna try it. It doesn't matter if I lose. I haven't taken a trade in a while. I'm just gonna try it. And then it lost.
What did you have your drawn liquidity for today? I don't really have one right now.
Lower here. But yeah, what I'm saying is I wanted to see some manipulation before going there.
Wow.
So that's why I decided to just take the long. I just wanted to trade. So that's the loss. It was a bad loss, but at least I followed the rules in my trading plan. That's why I'm not really mad about it.
So it was a good loss.
Yeah, like it was a one of those losses where it really tells you, you know, how to be more patient and wait.
Yeah. A losing trade is part of a winning system.
Mhm.
Do you want to see my Notion journal for today?
Sure.
Okay, let me just change windows. Yeah. Yeah. Do you see it?
Yeah.
Okay, so I actually used what you taught me yesterday about the UX. So you can see we have this accumulation here, and then this giant abnormal wick that people will see as manipulation. But if you remove the wicks, this body stayed in the same range as this. So what I was anticipating is that
Mhm.
this big drop lower was manipulation, and then I'll go into lower time frames
Mhm.
and I'll reassess on lower time frames to see if there's changes in state of delivery, and then we eventually deliver to the accumulation high or the data high. But seeing how we're reacting off of let me change the window.
The only thing with what you're the thing is with that is that even though we did wake up there, we still wick quite significantly. So sometimes we'll leave these huge wicks. That's enough to make it go lower, and then it'll come back only like a couple days later. Because on the bigger time frame, this looks like solid resistance, but intraday it clearly took out all the liquidity. And anyone that was longing CPI intraday saw this and then probably decided to chase, and then that was manipulation for the intraday move. So I think like the day has basically moved already. It's like pretty much done moving. It might run down to this sell side down here. It could retrace a little bit, but I don't think there's anything else that you'd want. I'd feel comfortable sticking for. But maybe tomorrow PPI might push price higher.
You know, as part of the week, I expected this whole week to be just a full bear run, just to retrace since of how it moved last week. There was lots of unbalanced price ranges within this move higher on this daily.
Mm.
So
Yeah.
if we inverse this volume imbalance, it's like kind of it's like there's two in one. If we inverse it,
Mm-hmm.
honestly, tomorrow I might expect us to move into equilibrium of the range, or not tomorrow, like from now until like sometime the next week. I don't know if this is too steep of a thought, but if we can, because if we were to move higher, then I'd imagine we want to do it off either this imbalance or this volume imbalance. Us reaching all the way down here, I think would contradict the point of us going any higher. I think if we reach all the way down to discount, we just have to go lower and maybe take out these equal lows and meet lower prices.
Mm-hmm. That makes sense. No, I mean, I'm 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 not too confident that might happen. I mean, it could happen, but this could be manipulation for PPI, sorry, tomorrow to expand higher. It's possible that it just does that instead of continuing to go lower. But I'll have to see how this day closed first before
Yeah.
having a better idea of what PPI is going to do.
What is that look back thing that you have? What is that? Is that the IBDA
That's
look
an
back?
IPTA range. Yeah.
Can you give like a
It's
brief
an
explanation?
for Well, yeah, basically you look back 20 days, it's 1 month of trading data, and then look ahead the same 1 month. And the algorithm's going to look at price action within 20 to 40 to 60 days. So all the way to 60. And it's going to look at highs and lows and fair value gaps or areas of liquidity within that previous 20, 40, 60 days. So whenever I see a big market shift, like a breaker form, and it's clear there was some manipulation on daily chart or even hourly chart, I'm gonna look back 20, 40, 60, or 3 months, and then look, and then I want to see, let's say, a low within 3 months. I want to see that low get hit within the next 3 months, or however long until that look back expires or gets to the end of it. Like on the hourly chart, you had um, this long wick. If you consider it manipulation, and you could consider this a market structure shift, then you want to look back from the daily days open, 3 days, so all the way back to Sunday, and you have the low of the week. That's why once we reach down to the low of the week, I really wouldn't have any more shoring bias because there's nothing else on the 3 day look
Mm.
back to really target other than highs. So if we reach down there today, PPI might retrace into this current day and maybe attack towards the highs. I don't know if it's going to continue dumping just yet. That's how I use the IPTA.
Okay, so for today, you think you're gonna reach down to those lows, that 60-day candle look back low?
Cut out.
I
Oh,
cut
you
out.
cut out what you say?
I
Yeah.
said, do you think we're gonna reach these equal lows today, or? No, because they
I
have been
think yeah,
on.
it's very possible. Yeah, make a new week low. We're pretty close.
But if you count this big move higher here before this huge distribution lower, if I can just take the standard deviation of this move. Oh, by the way, for the standard deviation of this move, would you take it just from the wicks or from the body? Because I know ICT said that if the wicks are abnormal, then just take the
Wix.
body.
You can do both. ICT does bodies sometimes. Yeah, the projections is the one thing IC says he's not very confident on. He says it often that he wish he could be. He's perfect on his entries, but he's not perfect on his exits. I mean, he's talking about his projections. He can't always project where a price is going to make the higher low by the tick. So I often don't try and do projections. I used to do them all the time. But if I'm just looking for 20 to 40 points, like a piece of the move, I don't need to know where the exact high or low is going to be. Personally, that's how I see it.
Yeah, but having the equal lows like directly
Mhm.
above the minus 2.5, which
Yeah,
I think he refers to it as the predetermined range. It makes it really high probability that if we see this low, we might have like a dig in deeper into minus 2.5.
maybe.
So
Yeah, that's true.
yeah, so if we take equal lows,
T-
it might reach minus 2.5.
yeah. What I'm saying is, to me, is it doesn't matter if does that or not.
So
So if
even
you,
if
you
hello,
ask me what I think about it, is that's what I mean. Like I just don't really think anything much about it. Hello?
you cut out for a second. Can you say that again?
Yeah, what I was saying is it might well reach down there, but if you ask me what I think about that, I'm just telling you that, like me personally, I don't really care to see it go there or not, because unless you're using Doctor AK's stuff, which is apparently very precise, I don't think it matters. Try and time the exact low.
What do you think
Most of the
about
time, you're not gonna be.
what do you think about his stuff, by the way?
I don't know what he just said. It's a book.
I I read over the book like I skimmed like around it and I sent it to ChatGPT and I asked it to read it for me and what are the main takeaways? It's it's basically three indicators plus a whatever it's called. I think it's called a pivot point, and the three indicators are called R3, and they use some
Yeah.
like and they use it based on wicks and like basically the wicks they act as support and resistance. It honestly just looks like the consequent equation of a wick, to be honest. So like if you were to use it on this wick, it takes like a points, like mathematical points of it, and it would just like draw it out for you, and it would treat
Mm,
this point as like a level of support or resistance, and
yeah.
it would just
When you
project
try
for the
it for
prices.
long, if you do it for long enough, eventually it's gonna work and it's gonna show you very accurate. I mean, even projections. I've been accurate by the point, by the tick sometimes doing projections, but most of the time I have no clue if it's gonna actually go to that projection or not, and it sometimes goes past it. Sometimes I have trouble finding the right projection. So I mean, his stuff may work sometimes, but if it would work all the time, he'd be in here every day telling us where the high and low is, and yeah, that's all I need to know.
But it seems though
But
as
he
if
doesn't do
he
it every
found it
day.
recently.
Yeah, but no, he found it. I think he talked about it a week ago. Like he would today he would be telling us the target. I don't think he told us the target today. Let me ask. Let me ask him where the target is. I'm gonna mess with him. You know what's the worst thing about the loss I took today?
What?
I'm I've been doing an event with my friend in the afternoon.
Yeah.
We're uh we're part of an event selling pizzas, and so he he's a big business owner and he is into stocks. So he says that he bets if he just holds the Nasdaq just the whole year, he could beat me in trading. And Obviously, I laughed at him, but in terms of percentages, it's hard because I trade on leverage. But I don't know. In terms of money, it could be different depending on how much money you're using. But I told him exactly what would happen today. I said, today's been going higher. Sorry, this week has been going higher, and then tomorrow we have CPI. I'd imagine it's going to be a softer release. Everyone's going to see the softer release, and then CPI is going to push higher initially, and everyone's going to chase it, and they're all going to act like you, saying we need to buy, buy, buy. Inflation's coming down, and it's going to dump. And he's like, no, 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 it's going to go up. And then, exactly what I said happened. So you better not ask me today if I made any money, because I don't know what I'm gonna tell him.
Who's up though now? Like for now, who's up?
Who's up?
Yeah.
It's hard. It's hard to tell because I made $1,500 so far this year, from trading, and I don't know what it is in terms of percentages, because he's just buying the Nasdaq. He
From the
can't
beginning
really
of the year?
yeah. Well, he's been holding it for a very long time, yeah. But you can't really There's not really much ways you can measure that. I didn't really entertain it much. I just said, look, I see where it goes every day, how it's manipulated, and how I can make money off of it. So he thinks it's he's one of the investors that is very safe. Thinks it's risky to do anything else but buy the Nasdaq and the S&P. Kind of like
Uh,
Warren Buffett.
yeah, yeah, I understand. Yeah, by the way, if you look at my screen, I put on the indicator that Dr. Ak uses for his pivots or CPR or whatever. Price isn't really doing anything right now. Just kind of slowly going down.
Yeah,
Yeah,
just updating the journal.
the 15-minute candle has just been consolidating so
I want,
far.
I want to see 579 and a quarter though.
579.
That's the current weekly low, I believe. Yeah. No, I also see today as a good, if any day there is to lose, is be probably the best day because I think if I would have won, I would not have been humble.
I
Would
wanna
have paraded around.
I wanna take a look at the weekly profile. Let's see where the week started. Where's Sunday? Okay, so Sunday 6 p.m. I'm gonna mark out
I have it on my chart.
what the weekly profile.
Yeah. Like you mean how we split up all the days?
No, I mean like the phases: the accumulation, manipulation, distribution, retracement, expansion. I want to see how it looks like on the.
Do I think it's accumulation manipulation?
It looks
Um,
like, does this count as manipulation lower? This small wick here as part of Sunday, because the week opens
no.
at Sunday 6 p.m. This small wick lower, move higher, retrace, and then expand. Uh, I don't know if this is
Well,
counted as a manipulation.
honestly, what I would do is go back to 2023. We had a similar scenario where
2023.
in May, yeah,
Let me open that. Is that
change it.
NQ?
Hold
What
on, there's some stuff on my chart that is not off the daily chart.
is it NQM? NQM 2023.
NQU,
2023. Yeah.
yeah. So if you go back to this current contract around last year, you see it's just going up and up and up and up and up. There isn't really much, some news like really drives it lower. But as soon as we just drive lower just a little bit, if you go back to around June and May,
June and May.
see we have like kind of like the same thing as we have right now. We dip lower. We don't really start this really big move lower. We instead just like maybe have one or two or three down close candles and then we go higher. So that CPI might make a low the weekend and see another high. Right. And this keeps going until July, right? Midway July, we start to consolidate, and then we start the seasonal tendency in August. We trade lower. September we go higher, and then October we make a new low, and then we do the Santa Claus rally. That's like the seasonal tendency. So right now July it's just like it's gonna end up consolidating probably, but I still think that usually the first half of July is still pretty bullish. So like I'm still bullish on the daily chart, even though today formed an order block on the daily chart. And you might think at the time, this is starting a deeper run lower, but I don't know. I think it's very easily could just continue running hard.
Also, about the monthly open for July.
Yeah,
I want to I want to see how it's looking for. Okay, so do you think that maybe the first week of July was a distribution or expansion from the previous week before we started July? Because there's something that I refer to as like a macro axis. So it's just basically like um so a macro is not a macro because it's a magical number. So it's not a magical time in the day where price just has more volatility. What macros are is at the last 10 minutes of every single hourly candle, and not even only the hourly, the 4-hour as well as the second and the 5-minute, most candles, what happens with them, like the anatomy of a candle, it opens and then manipulates and then distributes and then closes somewhere around the low in this case, right? So you can frame every single candle close as a retracement into some sort of equilibrium, like the equilibrium of a range. And then the next candle open would also manipulate higher if the drawn liquidity is lower. So hold on, let me make this more clear. So let's say we have a drawn liquidity lower, okay? And we have the 9 a.m. candle open. It opens and then it manipulates higher. And then we start distributing lower towards drawn liquidity. And then towards the last 10 minutes near the close, we retrace higher. And then we have the 10 a.m. candle open. If the drawn liquidity is lower, we're supposed to manipulate higher. Is that correct?
Yeah.
And then after
we
have this
say it again. You cut out a little bit.
From the beginning or from the new candle open?
Can you start from the beginning?
Yeah, sure. Okay, so let me draw this out nicely. Okay, so say this is 9 o'clock hourly candle open, and say this is the 10 a.m. candle open, and this is the 10 a.m. candle close. So let's say that this is the drawn liquidity here. So let me just write it down. Okay, so this drawn liquidity.
Let me just close my. Hold on.
Okay.
I had to close my trade. It was way too hard to focus. I could not focus on what you were saying.
Okay, so let me say this as clearly as I can. Okay, so a macro is not a macro just because it's a magical number or it's a magical time of the day. A macro is a macro because of A and B conditions. So let's say the 9 a.m. candle open would start at this line right here. It would open. If the drawn liquidity is lower, what do we expect the first 10 minutes of the candle to do? To manipulate higher, since every single candle has a manipulation and then distribute lower. Exactly. So this manipulation higher would count as like the macro of the previous candle, since the macro is from 850 until 910. So let me draw this. Okay, so let's say this is 850, and here this is 910. So what people presume as a macro is just a manipulation. It's a manipulation of a candle close and then the manipulation. So after 910, we start distributing lower, and then we close at the low. I mean, we reach the low and then we close near the low. After this, we have, let's say, the 10 a.m. candle open. The same principle applies onto the next hourly candle. Since the drawn liquidity is lower, the new candle open will manipulate higher and then move lower, eventually to the drawn liquidity. And basically what this is that the macro, this macro here is a macro retrace. I think someone teaches this. Yeah, the person that teaches this is called Economics. He's probably one of the best ICT students that you can watch.
Who?
Economics. I put his name down. This guy.
Economics?
Yeah.
Economics. I've never heard of him.
He's really, really good. Like, he's incredibly good. It's unbelievable. So does that make sense? I don't know if I explained it correctly.
No, it makes sense. What you're saying is basically the macros should make the high or low of a expansion.
Let me find an example in the chart. I think it will explain it better.
I think I have plenty of examples. I just need to look for them. Because I used to use macros all the time, and eventually it's kind of like
here's a nice example. Here.
It just became too much. Like, I don't know.
Okay, so if you look at my chart, you can see the 850 to 910 macro is right here.
Yeah.
Right?
Yeah.
So the 9 a.m. candle would open right here. And since in hindsight, the drawn liquidity was lower, what happens is, these lines, what happens is that price at 8:50, it starts to retrace higher. So what the 8 a.m. candle would look like is that it opens, it manipulates lower, and then it distributes higher, and then oh no, it opens, manipulates, and then manipulates higher, and then starts distributing lower. Near the close, it closes near the close.
Mm-hmm.
And then after we get this, we get the new candle open at 9 a.m. candle open, manipulates higher in the same direction which the previous candle closed. And then we start distributing lower to draw liquidity. I think I have a PDF that can explain this better. Not a PDF, I have a screenshot where I have like a schematic. Here.
Oh, I look at macros a little differently. I'm trying to find a good example.
I sent you the screenshot.
Yeah, let me see. Yeah, a little bit. Basically, I'm trying to find an example to show. Yeah. Maybe I'll just show you instead of actually finding an image.
Okay.
Oh, here's a good example. Let me send this to you. I don't know if it'll let me.
I can see your screen.
No, but it's a picture from
Oh.
my journals. So you see the macro, the 250 to 310.
Yeah.
I can show you on my screen. I often look for macros to sort of make that manipulation during the macro, and then go lower, and then start the expansion after the macro, or maybe at the end of the macro. But I would look for those highs and lows to be placed within the macros. Like there's another macro here, and then maybe retraces, and then during the macro makes another top or makes a low, and then continues going lower. So I'd use the macros to kind of like time my trades. If I'm in a trade, I'd expect to take profit during the next macro because it's more likely to put in a low during the next macro. And then that's my first ever model, which is the background of. Let me share my actual screen. Um, this is my first ever model. Do you see it? The
Yeah, I see it.
background. Yeah, so this is my computer background, but the macro time that was meant to be like a 9:50 to 10:10 basically, and then a 11:50 to 12:10, or 10:50 to 11:10, and 9:50 to 10:10. So yeah, I use the macro times to see manipulation and highs and lows to be put in during these macro times. But now I just don't really look at them anymore because I find that they're not. It's like SMT. It's not really necessary. It can definitely increase your accuracy, but it's just another thing to focus on that I feel if I'm just trying to make money is not really something I need. just focus on. It's just
Yeah.
another distraction, in my opinion.
But if you go back to the model you have, the the breaker you have being created, that's basically what my model is right now. Getting in before the breaker is created, like taking from the lower low to the higher high. That would be the trade that I would take.
Mm-hmm.
What you're taking is the
It's the
retrace
easiest
into the
trade.
break. Yeah, what you're taking is the retrace into the breaker and then higher prices.
Which one? The trade I just sent you?
No, the model, your first model.
Oh, this one? Yeah, this is not a model I trade. This is not how it looks like. It's not just a simple breaker setup. It's like it's supposed to be a higher time frame model, like this. You have I don't know, 15-minute chart would be better. You have this run up, so I would measure this run up, and I would call it a landslide. And once price closes or really shows it wants to get beneath that on at least a 5-minute chart and it's like closing, I would short the first bearish order block or fair value gap. So in this case, I'd probably look to go short on this mitigation block. And then I would put a stop loss at 75% of that range and have deviate the range, project it, and aim for one projection or nearby sell side liquidity. So it was kind of like more of a model that I used to build a bias. So I would have like if I expect this to play out, I would look for very good price action, very high probability longs within that low to this high. And then once we get above it, I would expect even faster price action with no retracements. It's done retracing. I mean, inside this B, it can retrace, but after the B, it really just runs. So if I'm holding a partial, I move up my stop basically, and I would use this as a bias to help me hold trades or things like that. This model actually, but like the model you see, the entry on the institutional or order flow entry drill, I would never take that because it was just so far up into premium that it was already done the manipulation, the initial move higher. It was like a second stage um entry that I just wouldn't take. Like it's not what my model I actually looked for and to actually trade.
But it looks like it's very high probability. Like you have to have very strict conditions for it to occur.
Exactly. Yeah, you do have to have very strict conditions. It's not something it maybe happens every week, but there's a lot of things that like a lot of times it may look like it and then it just doesn't. Even just the breaker setups, what I really just the turtle soups I trade, I could have said there was a turtle soup here, but why didn't I try and go long here? Because we want to draw two, which is in the IPTA data range. And order flow in the higher time frame is bearish, so wouldn't want turtle soup that. Same thing should have been up here, but I failed there and then ended up going long, and I took a loss for it, but it happens.
Yeah, I'm gonna end the recording right now because it looks like we aren't gonna do anything, and lunch is gonna probably gonna just accumulate a bunch, and then we might get some
Yeah,
nice moves during PM. But I think AM did
yeah.
its move, and lunch gonna consolidate and whatever. We might use lunch lows to maybe trade higher as a 130 juju swing.
Mm-hmm.
But for now, I'm just gonna end the recording because nothing's really happening.
Nice man.
Okay, so.
Good.